Hey, left, right, out. Sitting here at the open watching this stuff, as today is where the Fed comes out with what they're going to do. We all are anticipating a rate increase, the federal funds rate. Right now, it's kind of baked in, 3/4 of a point rate hike or 75 basis point, which would bring up the rate over 3%. As we've seen, if you've been paying attention the last few days, we've watched the bond market go up or go down because there's, like I said, just bond 101, inverse relationship between yield and actual price of the bond. So we look at the 10-year, which I'm not going to go into, to the short end of the curve, which we know is, it's inverted. It's getting closer. It's getting shorter to shorter durations. And we're seeing, I know we've seen like the 2-year thing hit 4% yesterday. But I'm going to predominantly look at this 10-year. The 10-year's at 3.54, and it's down 3 bips, or you could say it rallied a little bit. But we're solid over 3.5 right now, and it looks like that support's going to maintain, especially when the Fed raises the rates. Which, what does that mean? Like I've talked about this a little bit. Well, one, let's go into how they're going to fight inflation, because I want to bring this up because I'm the one that's been I brought up this topic, and that is not only do they need to roll the balance sheet off, like they've said QT, they need to raise interest rates, but they also need to raise reserve requirements, because if they're really going to target the customer or the consumer, who now that we have consumer prices as a fixture of the CPI price raises or pricing increases, the consumer is still relying on credit, and he's still going out there. He's tapped out completely. And we see monetary expansion through the reserve side of things, through the credit system, through credit cards and whatnot, consumer credit. So they should target the reserve rate, at least move it up to where we've historically had it, at least contemporarily, like in the last 50 something years. 50 to 70 years. So maybe, I don't know, because it's essentially at zero at as far as I know. But that is another way they can fight inflation and suck money kind of out of the system. Or, so banks just can't create money through the and with a multiplier effect. Anyway, so we go over here to this other aspect of the bond. So let's talk about that. So what happened, what I've talked about when I had my 1.25 call, which I still bring up because I guess I'm wrong on that in a sense. I think that I'm since right in a number of companies that are zombie companies that are trying to roll over debt, or if they have to use debt to pay things, that those costs have now increased, and maybe some of them can hold on at 1.25, but I don't think. I think as we get up higher, now we're at 3.5. Now, if you're a company that's got to roll over debt, or you need to hit the debt market because you got to make payroll, not only is those interest costs are now taking up that much more of your cash flow, or whatever your revenue, that's taking up a predominant amount of money that's coming into the business. That's less money that you have for capital investment. That's less money you have for the employees that you had, even though you probably shouldn't exist to begin with if this is the rate that's going to destroy you. But there's a lot of zombie companies out. Before this interest rate hike cycle even began, we noted that I believe it was like close to 20% of S&P 500 companies were essentially zombie companies. Now, whenever they have to tap the debt market, now you're looking at substantial increase of cost. Now, we also look at the government. The government itself, since it has so many short duration bonds, as those roll over and they have to re-enter the debt market because they have to, look at the additional costs that are being placed upon them by borrowing at these current rates. And I'm not arguing for lower rates, don't get me wrong. We need an actual market-based system of interest rates, which we don't have. But this is indicative of a socialist system where you pick rates or you pick prices and you're trying to hit the clearing price, and you can't. You're always going to be off for the most part, unless you're just super lucky every once in a while. But the market's so dynamic that even if you're lucky at one time, you're not able to react in such a timely manner. So they're always going to be down, or they're always going to be below the market, or they're always going to be above the market, which creates its own problems, which we're seeing now. These problems, these disconnects, is not just, they're blame COVID and everything, but these things have been building for decades, all because or the root cause, I won't say all because I'd say the first note is this monetary policy, the socialistic monetary system that we have. But so we look at the additional costs that the government's going to have, that's going to incur rolling over debt, and will the Fed? I believe the Fed stepped in a few times in the bond market to hold certain things down. They can't do it all over the place, otherwise it just becomes very. It's blatant that they're stepping in and fixing the bond market, which they do. That's why they're, they monetize debt. They can do it through their prime dealers. They can, and it seems like they're doing it directly in a sense, or they're doing it overseas. There's stuff that we don't know about what's going on there. But so what do we see? I don't want to we can go deep in the weeds some other time about that. I just hit that a little bit, but it looks like the bond market is kind of, we're seeing the 10-year reflect a little bit of the nature of what's going on here. I wouldn't be surprised if it hits 4% here soon. But like I said, every time this thing goes up, every time the Fed funds rates goes up, because we've built our entire system over the last few decades on cheap, or I'd argue more than that, but let's just at least call it through 2008, on unreasonably low interest rates, fixed rates. We've built an entire foundation of an economic system or an economy on BS, essentially. So when you actually have interest rates go up to where they are in a market where savers can actually make a little money or whatever, you have these companies that are relying on that. They become stressed. And are they systemic? Are they going to hit issues? I don't know. We also look at, and I got some other anecdotal stuff about businesses because I've been tied in with a couple businesses here helping out, doing various things of nature, and just to see how much they rely or how much money is spent on like government, like different entity inspections, payroll, all kinds of stuff, and the amount of customers that are on some kind of government assistance that I've seen it's a unbelievable number. It reminds you of late stages of Roman Empire where the government was involved in everything and people were on the dole everywhere. But anyway, so I wanted to talk a little bit about the housing market, because now we're seeing people that need to get housing. Like I've just talked to somebody that needs to go up a house because they've got too many kids. But they are now facing the reality of the fact that not only do they have to go up a house, and that would increase their monthly payment because most people don't have down payments anymore. Not only that, if it, in the state that they bought, these folks, an example, and there's a lot of other people like that, they bought within the last 2 years, they have like a 3%, whatever, 30-year. But even if you took that 3% and you went up and they have to go up another $50,000 at that market level of house, let's couple on the fact that now not only has that house increased now $50,000 or whatever, it's probably more so to get that square footage. I know that sounded confusing. I lost my own train of thought, but let's just couple in the interest cost now. Now you're doubling the mortgage rate on that. Not only you couple that with the principal amount that you're getting or you're having to come up with, and then you also have to sell your old house in a place where not necessarily it's the most friendly, because people that whatever $160,000 home that you bought 2 years ago come today and you got a 3% mortgage, another guy has to come along, be willing to pay even greater. Well, even if he gets that 160, now he's got a mortgage rate at 6-7% as opposed to your 3%. You look at the cost of that mortgage and the additional pressures that puts on people. It's incredible. Like you start unweaving some of these numbers and you're like, how did we even get to this point? Well, like I said, that you go to the chief node, it's just this loose monetary system, some stuff that is not allowing a market to actually, do its job, which is, find, independent people finding a agreement and a price, and then also clearing out unprofitable companies or unprofitable ventures. We don't see that. So you have these almost like a FOMO in the real estate market again. But you look at, there's a lot of people like that. So these people, then if they have to get, so you see some demand in that regard. So people are trying to get into a bigger home. The costs are going up. I don't even know. I haven't done the entire math. I just know that the interest costs are significantly higher, and people are still trying to get what they can out of their house. So you got prices that are up. You got prices of the loan are up, but then they also have to get out of their old house if they're not renters. And it's just an incredible dynamic. There seems to be a lot of people like that right now that I've talked to. So there is still demand out there, but some people are getting slapped with a real hard reality that we're no longer in that you know buyer's market anymore, or seller's market, or whatever it is, where we're just such a disconnect in the market itself, especially in the housing. But then we look at some of these other warnings. We look at FedEx warning. If you ever try to ship anything lately, the costs are going up astronomically. I still see shortages at the store. There's still shortages. Wait till you get to Thanksgiving. You're going to see your turkey is going to be astronomical. And that's because that is inflationary pressure. That's also because you had a large portion of the flock in this country had to be wiped out over the avian flu that happened earlier this year. Like, I've talked about the crops, I've talked about that, I've talked about eggs, and chickens were part of that too. They had to be wiped out. A number of chickens, and over tens of millions of chickens had to be wiped out because of this flu, and that has effects as well on the supply side. So it's an interesting dynamic. Anyway, we're watching this market. For some reason, people are still buying into this as if raising rates is going to be good for them. It will be good in the end if we can flush out some of these bad companies, but I don't know what the market is doing. Every time the market goes up with this, it just justifies even more rate hikes. So it seems odd that it would be up almost. The S&P is up right now 0.75 of a point almost, and so is the Dow, and NASDAQ's up half a percentage point. It's kind of weird, but I guess it's indicative of this generation who hasn't had to deal with some of these issues. And you see him on CNBC just talking everything up. Everything's a buy somewhere. There's just always nobody. And if they are somewhat bearish, they're so lackadaisically milquetoast bearish. They don't really understand what the whole problem really is. I guess on my side of things, I'm still short on this stuff. Short through various mechanisms, not directly short any stock or anything. I'm short using inverse ETFs. And I'm not saying you should do that. You should look at certain things and look at certain options. I'm looking at those gold stocks too. I've talked about that, and that's one thing that I would do, is because when the Fed does reverse, well, we want, when they raise these interest rates, and gold's up today like $10 and silver, but I think my overall view of gold, yes, it will be up, and the reason that being, you'll have a short-term pressure on it if the Fed actually does do something meaningful, which to me is good, and it puts pressure on those gold stocks. You get in then on selected gold stocks or ETFs. I'd do your own research. I've got my companies, but out of fear of getting struck down on theirs, I'm not going to say anything. But I look at those companies. I have price targets for when I'm going to get into. Granted, I'm not like some millionaire or anything, so I buy a few shares here and there as it hits that price target and as it goes down, knowing that these things are profitable, knowing even with gold getting some pressure, seeing the yield on there as well. So you're collecting a dividend while you wait. And on the companies I'm looking at, but then at the same time, I'm wanting them to raise rates. I want that pressure on there so that I can get it at an advantageous price. And then when they reverse and we see that money flush back in, yes, it's going to go all over the place. But then you see gold taking that other leg up, as it has over these number of years, every time we have like these kind of cycles. So that's how I'm playing it. That's my next step. Right now, I'm still short until we get that flush down. We haven't had those days of real capitulation yet, because we have the bad earnings and we have those companies coming out saying certain things, but we've had some bankruptcies, but we haven't had that one moment. And you think like a Ukrainian war thing would or FedEx, you think you'd have that. You think that the market would react on certain things. Peloton, different companies coming out warm, but I guess the market needs to slap somebody in the face. A company needs to come out and be like, oh, we're done, and we have to cut whatever, half the workforce, or you need a crypto crash. Something that really puts in perspective the reality of the situation. It's going to happen, because we can stave off the reality and until it slaps us in the face, or they can, what the market's trying to do is forward price in the future reactions of the Fed. But eventually, here soon, they're going to react to something that's going to slap them in the face, and that could be a company going out, or it could be the reality of whatever it could be. I don't know, a mortgage company going out of business. I mean, I could see that happening. I know some of them have talked about laying off people, but as things dry up or whatnot, I wouldn't be surprised if that happens. But I don't know. That's not really a call. I'm just saying we got to look out, because this could happen anywhere. Somebody that's like a short investor probably has a better situational awareness of where that could happen through, if he spends all day studying various aspects of of sectors and companies and whatnot. He probably has a better understanding of where those weaknesses are, where the interest rates will really hit them hard. Where these companies are getting ready to roll, they're going to have to roll over, or not roll over, or enter the debt market and take on a bond with a coupon value, whatever, 7, 8, 9% or whatever. So it's interesting. I know there's been some calls in the junk bond market, and I would look into those as well. But anyway, I want to talk to you later. Peace.